Well, joining me right now, right here on set, is Kathleen McCarthy. She is the global co-head of real estate at Blackstone. And it is great to have you back here. Welcome.
So good to be here. Thanks, Morgan.
So let's start right there, because it has been a fascinating dynamic to see rates, particularly at the longer end, move higher since the Fed began cutting. We know the Trump administration is focused on the 10-year, maybe more so than the federal funds rate. What does it take to bring that down? And if it doesn't come down right away, what does that mean for real estate?
Well, real estate's on a road to recovery. And I think you and I have been talking about this for, it feels like a year now, because really we started to pick up those pillars of recovery coming into place when we started seeing the short end of the curve come down and then additionally spreads coming in. And that's been happening because more capital is coming back to the real estate space. So in 2024, CMBS issuance was 3 times what it was the prior year. We're now seeing really banks get back and much more active as they've seen repayment activity and they want to be participating in this market with their big clients. And I think very importantly also, you've seen a sharp fall off in new supply. So you have this combination of things where our borrowing costs are down nearly 40% year over year because of that combination of spreads and rates. And then additionally, we're seeing in logistics, our highest conviction theme, new supply down 75% or more, housing down 60%. So that really paves the way to cash flow growth. You know, as far as the 10-year, I mean, the way I think about it is like this road to recovery was never promised to be smooth, right? There are going to be some bumps. That's an example of that. But I think you can continue to have great performance in real estate in a higher rate environment, provided that you have cash flow growth. And that's where we're really focused, is making sure we're in the asset classes and positioned to benefit from kind of this change in the supply-demand dynamic.
I want to get into some of the specific sectors you're focused on, but first, just one more macro question for you. We've seen gold on this record run, in part because of maybe fiscal uncertainty, trade and tariffs have been brought up, the possibility of inflation being stickier than expected. Real estate has long been seen as a hedge against macro uncertainty and inflation, too. So does this environment actually create more demand?
Well, we definitely want to be in the asset classes where you have shorter lease terms or leases that really allow you to capture inflation. But I'd say as it relates to inflation, when we look across our portfolio, not just Blackstone Real Estate's $600 billion of assets, but really the entire Blackstone ecosystem where we have 250 companies, what we see is inflation, very much coming under control. And we look at the rate of wage growth, we look at job openings, input costs, importantly, kind of increases in rent in our housing portfolio. And it would really actually suggest that kind of the environment is conducive to rates coming down. We anticipate we will be in a higher rate environment. But I think, again, like we see sort of signs that inflation is really in a controlled place.